When it comes to stock investing, one name inevitably comes up: Warren Buffett. Born on August 30th, 1930 in Omaha, Nebraska, Buffett has become a global symbol of investment wisdom, business acumen, and long-term wealth. But how did he get there? Buffett was born to Layla and Howard Buffett. His father, a stockbroker and a member of the U.S. Congress, introduced him early to the world of finance. It didn't take long for young Warren to develop an entrepreneurial spirit. At just 6 years old, he was already turning a profit by buying Coca-Cola bottles from his grandfather's store and reselling them for a small markup. At the age of 11, Buffett made his first stock purchase: 3 shares of City Service Preferred at $38 each. The stock initially dropped in value, testing his patience. Eventually, it rebounded slightly and he sold, earning a modest profit. But to his dismay, the stock kept climbing, eventually reaching 5 times the price he sold it for. That experience taught him one of his most enduring lessons: patience pays. Buffett earned his undergraduate degree from the University of Nebraska-Lincoln and completed his master's at Columbia University. There, he studied under legendary investor Benjamin Graham, whose teachings would shape Buffett's early investment philosophy. After initially being rejected for a job, Buffett was later invited to work alongside Graham. However, as their partnership developed, it became clear they had differing approaches. Graham focused strictly on numbers and balance sheets, while Buffett looked deeper, analyzing what made a business outperform its competition. Eventually, Buffett struck out on his own. With backing from family and friends, he launched Buffett Associates and began investing in undervalued companies. One of them was a struggling textile firm named Berkshire Hathaway. Instead of sticking with textiles, Buffett pivoted. He shut down the underperforming manufacturing division and began acquiring high-potential businesses in media: The Washington Post, insurance, GEICO, and energy, Exxon. His uncanny ability to spot value where others saw a decline earned him the nickname the Oracle of Omaha. Investing isn't just about buying cheap stocks. It's about knowing what you're buying into. Buffett emphasizes doing deep research into a company's operations, its leaders, and long-term viability. Blindly trusting a company's reputation or hype is a risky move. Buffett is known for investing in undervalued companies, those trading below their intrinsic value. He particularly favors businesses with low debt, high return on equity, ROE, and strong fundamentals. ROE measures a company's ability to generate profit using shareholder equity, and a high ROE often signals a well-managed company. Buffett famously advises, "Be fearful when others are greedy, and greedy when others are fearful." He practices what he preaches. During the 2008 financial crisis, when most investors were selling, Buffett bought into Bank of America. Years later, that investment paid off handsomely. Emotions can be an investor's worst enemy. Many people panic during downturns and sell too soon, while others blindly follow trends out of FOMO. Buffett stays calm, rational, and patient, which allows him to make decisions based on data, not drama. Buffett doesn't chase quick wins. His strategy is built on long-term value, sustainable growth, and trust in the businesses he invests in. His steady, disciplined approach is the reason he's remained successful for decades.